Hello everyone, thanks for checking out my video. The S&P 500's longest bear market since about 80 years ago has finally come to an end. The index has risen more than 20% from its recent low in October 2022. However, the rally has been powered by only a handful of companies, mainly the big tech, such as Apple, Microsoft, Meta, Nvidia, and recently Tesla. Therefore, the key question now is whether will such rally be sustainable. Coming up this week, we also have a potential landmine in the CPI number as well as FOMC meeting. Let's discuss all of this in this video, so do stay tuned. Last week was nothing less than impressive as S&P 500 reached its highest level since August 2022, and Nasdaq clinched its 7th straight winning week, its first streak of this length since November 2019. That's about 3.5 years ago. Another fun fact, the S&P 500 had been in bear market territory for a total of 248 trading days, which is the longest run since the cycle that finished on May 15, 1948, which lasted 484 days. Interesting, huh? Anyway, to make things even better last week, there were more signs that the rally is gaining breadth, with small and mid-cap stocks participating in the uptrend. In case you're not aware, for many months, investors have been piling their money into blue chip and big tech mega cap stocks only, and the market rally has been pretty much concentrated among this small group of stocks. But recent good news such as the end of debt ceiling crisis, optimism that the Federal Reserve will pause rate hikes in the upcoming meeting, and a string of strong economic reports have given the stock market a positive momentum. This week, the market will be looking towards the Consumer Price Index, aka CPI data, set to be released on 13 June, as well as the FOMC meeting on 13 and 14 June. Markets are currently anticipating a more than 71% probability that the Fed will pause on rate hikes, according to the CME Fed Watch tool. In my view, the Fed could go for a pause, but a hawkish one. Jerome Powell would probably caution everyone that this pause is for them to study more economic and inflation data, and would likely not rule out the possibility of a rate hike in July. In fact, this is something that the market is sort of anticipating too. And I thought it would be prudent for the Federal Reserve to have this pause to let the lag effects of rate hikes to play out a little bit more. Anyway, that's what I and the general market are expecting. So if we get something out of this norm, say Powell decides to hike the rates this month, well, please expect high volatility in the stock market. But all in all, I would think the market has priced in one more rate hike in the next 1 or 2 months, and that we are approaching the end of this entire rate hike campaign very soon. Okay, let's now move on to the technical analysis segment. Well, it doesn't need a rocket scientist to know that SPY's chart is looking bullish. But let me share on something. Last week, SPY did a textbook test and rebound move. As you can see, the level 426 is August 2022's high, and that was a resistance level. And once we broke above this level, it became a support level. So last week, SPY retraced and tested this level, and then rebounded on 4 out of 5 trading days. That's bullish. Come early this week, SPY is likely to chop around this range until CPI number is released, and or Fed announces their decision on the next rate hike. These two key events are crucial in determining whether SPY can charge towards the Fibonacci extension level of 445 or not. If 445 seems too far away, the next immediate resistance, at least to me, is around 441, 442. Not much difference from 445 actually. So, as the key events unfold this week, watch how SPY reacts to the 426 level if it gets retested again. If SPY continues to bounce off this level and remain above it, then yes, the bullish thesis could potentially play out in the next 1 or 2 weeks. However, if for whichever reason market decides to dump, could be a small dump though, and SPY broke below 426, the gap between 422 to 423 should be easily filled. From here, we can expect a decent support between 417 to 420 range. This area should hold up this week, unless of course we get some nasty news from Powell or the inflation data. So let's say if this area gets breached as well, the next 2 support levels to watch would be the 50 moving average at 414 and the gap between 407 to 408. All in all, I would say bulls should only be concerned if SPY starts to hit and break below the 61.8 Fibonacci level. If you take a close look at that area, there are a couple of key levels there. First, it is the obvious 200 moving average. And then you have that gap between 396 to 398. And finally, that area is also the bottom of this uptrend channel, marked by the two green dotted lines. So yep, anything above this area is considered as a healthy pullback. Let's now check out Apple. Similar to SPY, Apple has broken above August 2022's high, and the difference is that Apple has been staying above it for a while. Not just that, it went to create a new 52-week high last week before their event. And then we got a classic buy the rumor, sell the news move, and Apple retraced right after the event. Despite the slight pullback, Apple continued to hold above August 2022's high, as well as the gap between 175 and 176. This area will continue to act as a support in the coming week or weeks. As long as this area does not get breached, there is some chance for us to head towards 187.5, which is the next Fibonacci extension level. Alright, that's for the bull thesis. For the bear thesis, again watch out for this 175, 176 area. If it gets breached, then we will enter this consolidation zone that we had for the entire May this year. From this point, weak momentum and high volume will send Apple down to fill that big gap between 166 and 170. If Apple bounces off this area, that's bullish, and I may consider dipping my toes in a little bit here. However, if this area does not hold, then Apple's trend will have turned bearish in the near term as it falls below the gap, the 50 moving average, and the red downtrend line. When that happens, let's talk about it again. I mean, I think it is highly unlikely for Apple to fall below this gap before my next video, which is in 1 week's time. I could be wrong, we shall see. Let's now move on to Tesla. Tesla surged more than 12% last week, hit a 8-month high, and had a gain for 11 consecutive trading days. A quick recap, last week I shared the bull thesis of Tesla. So basically, if Tesla breaks above 217, we will then enter the consolidation zone that was created between May to July 2022. And that will likely unlock more upside towards 235 or even 240s range. I also shared that 217 to high 230s, that's about 20 points or about 9 to 10% upside. Look at where we are now, up 12%, and Tesla is at 244. If this doesn't warrant a like button, I don't know what will. Anyway, a very quick shout out. I hope you can support this channel via any of the following options. The simplest way is to like, subscribe and comment something below. These little actions will really help to boost the visibility of the channel. Alternatively, you may consider signing up for a Webull account using my referral link below. Webull is basically a low-cost brokerage which works like your Mubu and Tiger. Finally, if it's within your financial means, you can consider treating me to a coffee that will cost you USD $3. Okay, back to Tesla's chart. Tesla is about to hit a resistance level at around 255. And Tesla being Tesla, we all know how parabolic it can be. So further bullish momentum may just send Tesla above this level and starts filling that gap at 257 to 262. And this is also where the next Fibonacci extension level sits. And if you were to ask me, I think Tesla will likely get rejected at either level. In other words, 255 or at around 262. Well, I don't know about you, but I am not chasing this Tesla rally, as history has shown that every parabolic move up by Tesla was met by a significant pullback. Of course, I could be wrong, and I don't mind being wrong because Tesla holds the largest position in my long-term portfolio. Anyway, my view is that this run-up is way too extended. Check out the Bollinger Band. Tesla is way out of the band. I mean, I am happy that Tesla rallied as I am a Tesla bull, but technical wise, it is just painting a poor picture ahead. Also, other than the Bollinger Band, look at the RSI, it's severely overbought. The last time we were at this level was somewhere in October 2021, where Tesla was en route to all-time high. Of course, back then the RSI went even higher and was way heated than this. Could Tesla do it again this time? Possible. But in terms of risk-reward ratio and the potential upside versus the downside, I will err on the safe side and wait for a pullback before doing anything. This setup is a little like Google's, and yeah, Google had its pullback recently. Okay, on the downside, that little gap 235 to 242 is insignificant in my view considering the huge movement by Tesla over the last few weeks. If Tesla gets done, this gap will be easily filled. Support levels to watch would be 217 and the 200 moving average at around 197. Nothing to be too concerned or worried so long as Tesla stays above the 61.8 Fibonacci level at around 173. Alright, let's now talk about Google. I think right now it is quite evident that 125 poses a strong resistance for Google, while 120 has been a good support, as the stock has been trading within this range in the last 16 to 17 trading days. And do you recall I mentioned that the longer a stock consolidates at a tight range, the bigger the next move. And since I don't have a crystal ball, I can't predict what is the next move by Google. I decided to dip my toes in a little bit last week after Google printed a big fat red candle with high volume on Wednesday. And there was also a bearish RSI divergence. So I got in on Google on Friday, if you must know. The reason why I stepped in is very simple, because the RSI has been cooled down and MACD has also cut down for a few days already, something that I have talked about in my last video, and I honestly don't know when will Google starts picking up bullish momentum again. Technical wise, come this week, watch if 120 holds. If it does not, then my last week's MACD theory will continue to play out, and we could potentially fill the gap between 112 to 114. That to me is a healthy pullback and could be opportunity to step up more shares. Not financial advice, of course. Anyway, if we were to hit this level, it is not a cause of concern yet, unless we start to test the next support at 105. But this is a little far-fetched within a week's of price movement. On the upside, as shared last week, very simple. Google needs to break above 125 to unlock a lot more upside to the 130s range to fill that gap at around 132. Resistance will likely come in at around 135, 138 area. Okay, option trades. Nothing significant to highlight this week, but let's start off with something wow. Check out this Tesla's cover call trade. At one point, it was down by around 450+%, and then the next day it recovered 150%, but was still down 300%. Once again, I just wanted to take this opportunity to highlight to new option traders how volatile options can be, and you must be able to stomach such wild swings and volatility. And oh, if you are just starting out, you might want to consider checking out my video on basics of options trading and start off with paper trading first. Anyway, nothing much to update for this particular trade as the contract still has more than 20+ days to expiration and the strike price has not been breached yet. Moving on, I have one cash secure put contract that is expiring this week for Tesla, and I think I should be able to reap the full profit out of this option. More info on this trade can be found in my previous video under the options segment. The other trade that I have on hand is this cover call by Google, a trade that I rolled out and up previously from 110 strike price to 113, and it still has about 3 weeks left to expiration date. Just to highlight, the profit is not as it looks here because I have wrote this option. Once again, more on this trade in my video titled Bull Market is Officially Here, which I have linked it at the top. Some end thoughts for this video. Well, we are approaching the halfway mark of the year, and I still recall entering this year, recession talks had been everywhere, and there were still lots of doom and gloom news at the start of the year. But the stock market is either forward-looking or they tend to go against what the majority is thinking, or both. So they decided to rally and rallied hard. At this very junction, good news start to float around, such as economy remains resilient, Fed could be pausing their aggressive rate hike soon, debt ceiling showdown has been resolved, banking crisis has been chucked aside, the list goes on. Basically, the news are offering lots of reasons to be bullish. Technical wise, price actions are singing the same tune as well, with S&P 500 officially out of the bear market, and more smaller cap stocks are joining the mega cap stocks in this rally. But here's the but. With the Federal Reserve meeting coming up this week and the new CPI data to be released, I think it gives us reasons to be a little more careful, at least for this week or maybe even next week. To add on, looking at the technical charts, it basically tells me that they are overextended and they need to take a breather. I mean, it's like you sprint for 400 meters, can you carry on sprinting? Yes, you can continue to define the odds by dashing to 800 meters, 1 kilometers, 2 kilometers, etc, etc. But ask yourself this, do you need a break? Yes, right? So does the stock market, especially the hot tech sectors. With that being said, I want to clarify that I am not saying or implying that a big crash is incoming. Some people only need 5 minutes break after a 4 kilometers run and recovers. Some take 10 and some require a longer break. Therefore, the upcoming break that the stock market is likely to take could be a small or a big one. To be honest, nobody knows. My point here is, don't chase a raging bull, don't chase something when it is at extreme euphoria mode. Speaking of this, the fear and greed index is showing extreme greed at the moment. And when everyone else is on the same boat, remember what does the market usually do? I shared that earlier. Well, at the end of the day, the next pullback could be very minor, could be so damn insignificant. But to me, so be it, it doesn't really matter. The message here is to highlight that the upside is slightly more limited than the downside at this very junction, and I would want to be cautious as always. And more importantly, going back to what I have always been preaching, take baby steps, dip your toes into the market if you have cash lying around. And I did. I dabbled into Google last week when it retraced from 129 to low 120s. Ultimately, will this bull trend last till the end of the year? Or till next year? We wouldn't know. All I can say is, don't try to predict where this current market will go. Pay attention to what the market is doing right now. With that, I have come to the end of this video. Please support the channel by tapping on the subscribe and like buttons if you haven't. Thank you.